Okay, so next up, a couple other things that are different about corporations, different from individuals. Charitable contributions, there are limitations on the amount of charitable contribution that is deductible. Again, we've got some carry forward provisions to that. That dividends received deduction that I alluded to. Net operating loss carryback. So this is where not a capital loss, but a net operating loss. So you had a year or more where your expenses exceeded your gross profit, and you had a loss from operations. You get to carry that forward. So that's separate. So you could have instances though where you've got a capital loss carry forward and a net operating loss carry forward in the same year. So that is something that you gotta kind of keep track of. And capital loss carry back. We already talked about that. Anyway, okay. So contributions, charitable contributions. And these are those items where, think about this now. Think about this on remember that M1 where we're reconciling between book income and tax income. For book purposes, any charitable contributions that we make, we're going to expense. However, we're limited to the amount of charitable contributions we can take for tax purposes. So this is one of those areas where we would have an adjustment, most likely. Maybe not 100%, but most likely. The capital loss carry forwards and carry backs as well, we would have a difference. If we had a capital loss, we're going to expense that for financial accounting purposes, but we can't take it for tax purposes, right? It's going to be carried to a different year. So that would be another adjustment that you have to make. That dividends received deduction, dividends are considered to be income on the financial statement, and dividends that are received are considered to be income on the financial statement. Dividends that are paid reduce our equity. They are, I can't remember, are they expensed on the financial statement? It's been a long time since I've done financial accounting. Anyway, there's a difference between the financial statement and the tax return with regard to dividends and net operating losses. So you wouldn't have a net operating loss carry back or carry forward for financial statement purposes, but you do for tax purposes. All right. So any contributions, charitable contributions, in excess of the permitted amount are carried forward 5 years and are added to the charitable contributions in that year and are subject to 10% limitation. So we don't have a carryback of charitable contributions, but we have a carry forward. Now, I forgot to read this first part here. It's limited to 10% of taxable income before any of these items. So when you're doing the calculation to figure out what's 10%, we have to add back any charitable contributions that we've deducted, add back any dividends received deduction that we've taken, add back any net operating loss that we've taken, and any capital loss as well that we have taken. So any contributions in excess of the permitted amount are carried forward 5 years, added to charitable contributions in that future year. And then they are subject still to the 10% limitation. Now, for 2020 and 2021, the 10% limitation was 25%. They were trying to get corporations to make charitable contributions during COVID. And so they increased the limit, 25%. But then in 2022, the limitation went back to the 10% amount. Okay? So let's look at an example here. Zabo Company had $50,000 of taxable income before charitable contributions. All right, they're not saying anything about dividends received deduction or net operating loss carryback or anything like that. they had charitable contributions of $8,000. Their charitable contributions, though, are going to be limited to $5,000, 10% of $50,000 of taxable income. So currently, they can take $5,000 of charitable contributions, but they're going to have to carry forward that $3,000. That $3,000 is going to get added to whatever they have next year, but that $3,000 gets to be taken out first, or they'll get the deduction for that first. So if next year they still exceed the 10%, they get to count this $3,000 first, and then any additional contributions that they have that year will come after that. Okay, so kind of a first in, first out with the charitable contributions. But so you can see, as far as the book tax difference though here, we would have on our books, we would have a charitable contribution of expense of $8,000, right? But on the tax return, we have a charitable contribution of $5,000. So we have a $3,000 difference that we'd have to account for on that Schedule M1. The differences between the two. So if a corporation contributes ordinary income property, the deduction is limited to the basis in the property. So inventory, you contribute, the contribution is the amount that you bought the inventory for, not what it's worth, not what you would sell it for. Ordinary income property is property that, if it was sold, would produce a gain other than long-term capital gain. So any type. So if a clothing company has excess inventory, clothing inventory, from 3 seasons ago, they bought it for $3,000. They would, if they were to sell it, they'd sell it for $10,000. They don't get a $10,000 contribution deduction though. They get a $3,000 contribution deduction because that's what their basis is in the inventory. There's no carryback. So with the charitable contributions, there's no need to amend any tax returns because there's no carryback. Okay, so again, 10% of net income, taxable income before those items. So you do have to make that adjustment. Dividends received deduction. Again, this is a deduction, not a credit, but it's a deduction. Corporations are permitted a tax deduction for a portion of the dividends that they receive from other domestic corporations. Dividends received deduction is a percent of the dividend and varies depending on the percentage ownership that the dividend paying corporation. So if Corporation A owns 80% of Corporation B. So A owns 80% of Corporation B. And Corporation B pays a dividend of $10,000 to Corporation A. We use this chart to determine what percent deduction we get. Well, in this case, if it's 80% or more, we would get 100% deduction. So we have $10,000 of dividend income that we would report on the front of the 1120. But then we get a dividend received deduction, DRD, of $10,000 for a net effect of 0. Now, if instead of 80%, we own 60% of that company, that changes our dividends received deduction. Now, 60%, between 20 and 80% of the company, we get a 65% deduction. So our dividends received deduction now is $6,500. We pay tax on $3,500. Again, think about this. You don't get that on the tax return or on the financial statements, right? So that would be an adjustment on that M1 that we would have to make between book and tax. We'd have $10,000 of dividend income, but we would not have this $6,500 dividend received deduction. So it's all based on the ownership percentage. Less than 20% is a 50% deduction. Okay. Again, that's to help mitigate the double taxation, triple taxation, all that stuff, because there should be some sort of offset, but in this case there isn't an offset. So we got Duck Corporation owns 25% of Rose Company. Duck, I gotta write this down. What's the tax rate?
21%.
Thank you. You think I'm funny, but that's a question. I will tell you, that's a question on the test. And I'm always shocked at how many students don't get it. I'm like, it's so easy. That's like the easiest question on the test. So I know all of you will get it, but.
I mean, probably after they've asked what's the tax rate for X, Y, and Z, by the time you get to corporations, people probably just skip over the
Yeah, their brains are fried by this point. They've stopped listening. All right, well, 21%. Okay, so we've got Duck and Rose. Okay, so Duck owns 25%. I don't know quite how to represent this, of Rose. Duck received a $10,000 dividend from Rose and is entitled to a $6,500 dividend received deduction. Right, because it was between 20 and 80%. Means $3,500 of the dividend is included. If they owned 15%, that dividends received deduction would now be 50%, and $5,000 of the dividend would be taxable, and $5,000 would be a deduction. Okay, it's kind of the same example that I just did, except mine was A and B. So it can't be limited if taxable income before the dividends received deduction or any capital loss carryback, they can't just make it easy, can they? You'll see why here, is between 100% of the dividend and 50% or 65% as appropriate, so based on this. The dividend received deduction is limited to taxable income multiplied by the appropriate percentage. So let's look at an example of that. We've got Silva Silverware owns 30% of Fredonia Flatware. So 30%, that's 65%. Silva's taxable income was $50,000. So if taxable income before the dividend received deduction is between 100% of the dividend and 50% of the dividend. All right, so here's the dividend. Their taxable income was $50,000. Is that right? Yeah. So that is not between 100% and 50% of that. It's less than that. In this case, they're good. Their dividend received deduction is going to be $13,000. Now, instead of $50,000, their taxable income was $5,000. We're comparing that to the dividend that they received. Their taxable income is not between, ordinarily they would get 65% dividend received deduction because of the ownership percentage. Okay. We look at their income before that dividend received deduction. Is it between 50, is the dividend that they receive between 50 and 100% of that amount? Yes, it's more than 100% of that amount, right? Their taxable income is not between 65% of the dividend, actually in this case it's 65%, sorry, because we're at 65%. Wait, 65%? Yeah, 30%. They're 30% owners, so we're gonna use the 65%. My apologies. Does everybody have that straight? See where I made that mistake? Okay. 65% of the dividend and 100% of the dividend. So in this case, the dividend received deduction is not limited. So it's not, even though they're not going to receive all of it, because their dividend received if it's, before the dividend received deduction, their taxable income, so they must have had a loss somewhere else. And then a $20,000 dividend. So then they would get the full $13,000, which would result in an NOL, a net operating loss. Or, actually not a net operating loss because it's dividends. Anyway, sorry, I'm talking to myself. Okay, so 5,000, they're cool, because it's not between 65% of the dividend and 100% of the dividend. It's less than that, right? In this case, it was 20,000 is also less than half that. So, third example. So it was taxable income before the dividend received deduction was 18,000. So in this case, their taxable income is in the limitation area between $13,000 and $20,000. So the first thing you would do is figure out, based upon their ownership, which percentage you're going to use. If the dividend, calculate what the dividend is multiplied by that percentage. And then that between that and 100%. Let me see if I can write this out in a way that's more understandable. That's how I'm saying it. I know it's not very understandable. So, so the $18,000 is their taxable income. And that's before the dividends received deduction. The dividend, and then it's 30% ownership. So, at 30% ownership, they get a 65% dividend received deduction. But the first thing we have to do is calculate 65% of the dividend and 100% of the dividend, and that's our range. So 20,000 times 65%, 13,000, and then 20,000, we know what this is, times 100% is 20,000. That's our range. If our taxable income falls within that range, then we are limited. So then the dividends received deduction is limited to 65% of the taxable income before the dividends received deduction. Okay, so step one, let's see if I can put this in steps. I'm going to multiply. Let's see, find the range. Income range. So in doing that, what we're going to do is multiply the dividend by the dividend received deduction percentage, whatever that percentage is. That's appropriate. Okay. Step two is step one between step one between the dividend lost my train of thought again. thought. Dang it. Yeah, well, here, I'm trying to make it simple for you on the fly. I don't know if I've actually got one of these already set up. I remember thinking through this and putting it together on a board once upon a time.
Is that still for finding the range?
Yes, we're finding the range. So this is finding the range here. So is what am I looking at? Is taxable income, right? Is taxable income okay, multiply by, I think I went too far here. So multiply dividend by the dividend received deduction. Step 1A to 100% of the dividend, right? Find the income range for the limitation, that's what we're doing here. Step 1A, multiply the dividend by the dividend received deduction, 13%. Our range is this result and 100% of the dividend, right? So step 2 is step 1A, is the taxable income within step 1A range. No, not limited. Yes, limited. So it's limited to the dividend received deduction percentage times the taxable income. Okay, so let's see if that works. Sorry, I'm gonna move that over. So let's look at the different examples. So 30% puts them in the 65% range. They paid a $20,000 dividend. Their taxable income is $50,000. So step 1, find the income range. Multiply the dividend received deduction percentage. Multiply the dividend by the dividend received deduction percentage. So we did that here. 13,000 and 20,000. Is there taxable income within that range? 50,000? No. So the dividend received deduction is not limited. It is what it is. Number 2. So now their taxable income is $5,000. So our range stays the same, right? Taxable income though, dividend received deduction, okay, so we did this. Is taxable income $5,000 within this range? No. So it's not limited in that case either. In step 3, in the third example, income was $18,000. So we did the range. Taxable income, is taxable income within the range? Yes, it is. That means it's limited. So it's limited to whatever that dividends received deduction percentage is multiplied by the taxable income, which is $18,000. 65% times 18,000, so that's the dividend received deduction. Is that? Anybody want to take a picture of that? Does that help at all? Okay. I hope so, because that was painful. So the ownership percentage makes a difference too. So in this case, it was 30% ownership. If it was, let's just say it was 10% ownership, then our dividend received deduction is 50%, right? So our range has now changed. This becomes 50, this becomes 10. So 18,000 still falls within those, and the 5 and the 50 still don't fall within those, but it changes the range, right? Did you just take a picture of that? Will you email it to me? Okay, thank you. I can't remember if I have that written down somewhere. I vaguely recollect doing this a while ago, but I don't know. Okay, so, we're good. Other difference. Let's see. Passive loss rules, which we did not cover, don't apply to corporations either. Closely held C corporations have some special rules. Those are corporations in which 50% or more of the value of the stock is owned directly or indirectly by not more than 5 individuals. And I think, let's see, did we talk about that at all? I don't think it's in here. No, okay. Startup expenses and organizational expenses. So normally these are expenses, right? And what's the difference between a startup and an organizational expense? Well, startup expense is expenses that are associated. So startup expense would be expenses associated with getting the business started. You know, purchasing, I don't know, materials, supplies, that sort of stuff. Organizational expenses are expenses that are incurred in organizing the business. So like attorney fees, fees that you pay to the Secretary of State's office, that kind of thing, whatever it takes to get the business organized. So there are some special rules with regard to startup expenses and organizational expenses. These rules apply to both of them, but they apply to both of them separately. So if you can only immediately expense, let's see, up to, I think it's $50,000. Otherwise, you have to amortize it. So you can immediately deduct organizational expense equal to the lower of either the amount of organizational expense, I'm sorry, it's $5,000, or $5,000. The rest of it you have to amortize over 15 years. But if your total organizational or startup expenses exceed $50,000, then there's a phase out for that $5,000. Between $50,000 and $55,000 of expenses, you can take dollar for dollar any amount up to that $55,000. So if you have $51,000 of organizational expenses, you can still expense $4,000 of them because you're only $1,000 into that phase out range. Once you exceed $55,000 though, you cannot expense any of them. You have to amortize it over 15 years. Amortize those expenses. Because, I mean, chances are you don't have any income at that point to offset. And what they want to do is to try and keep people from forming corporations simply to have these expenses and they get a tax write-off, right? For things that they wouldn't ordinarily get a tax write-off for. So those are the startup expenses and organizational expenses. Corporate tax rate, what is it? 21%, yes, very good. Just flat 21%, so easy. Look at that. tax rate. Remember how much we went through with the tax rates for individuals? That's our tax rates for corporations. That's pretty nice, huh? Estimated payments. Corporations have to make estimated payments. They're required to do so if they owe tax. But they, the due dates of their estimates might vary though from other corporations. You know, with individuals, they've got those set due dates. But because corporations can have different fiscal years, their estimate payments may be different. Their quarters may be different, even though they're not really quarters. The installments are made on the 15th day of the 4th, 6th, 9th, and 12th months of the corporation's fiscal year, okay, or their tax year. So if their calendar year corporation, if it ends December 31st, that would be April 15th, June 15th, September 15th, and December 15th. Different from the individuals' due dates, which are April 15th, June 15th, September 15th, and January 15th. Yeah. So a little bit different there. Okay, net operating losses. A net operating loss is when the corporate entity has negative taxable income for the year. So there were a lot of changes that happened to net operating losses with so this 2020 CARES Act is all part of the COVID relief stuff. So NOLs fall into 3 different categories. There are 3 different, so this is, you got negative taxable income, right? NOLs that are generated in tax years between or before December 31st, 2017, and this is when tax years that end. Before December 31st, 2017, are carried back 2 years and forward 20 years. So you can see why we need to know this information, because we may have NOLs from that time that are still being carried forward. The corporation can elect to waive the carryback period and only carry it forward, but they can't reverse that decision. NOLs that are generated in 2018, 2019, and 2020 can be carried back 5 years. So up here, it's back 2 years and forward 20. Here, it's back 5 years and then forward forever. So they never lose it. Corporation can elect to waive the carryback period. That election is irrevocable. These NOLs can offset up to 100% of taxable income in 2020. So if it was generated in 2020, they can offset up to 100, and it's been carried forward. You can use up to 100%. It can offset up to 100% of whatever your current year income is. And before, and offset up to 80% of taxable income after 2020. NOLs that are generated in 2021 or later are not eligible for carryback, so there's no carryback. No carryback for NOLs, no carryback for charitable contributions. There is a carryback for the capital gain losses. And then they can be carried forward forever. So the only ones that have a limit on the carry forward time are the ones that were older, okay? These offset up to 80% of taxable income. These were always offsetting 100%. They don't mention that there, but it was 100%. So 100% before December 31st, 2017, 80% 2021 or later, the 2018, 19, and 20, it gets a little weird. It could be 100%, it could be 80%. So NOL carrybacks, carryback is first applied to the oldest year, which is like we did with the capital gain loss. And then any remainder is applied to the second oldest year and so forth. So just like we did with the capital gains. All right, so let's take a look at this one. Where are we at? I got just a couple minutes. Can I get through this? You guys have a little bit of time so I can, we're almost done. Let's go through these. So Wilson Company was formed in 2015, earned $10,000 in 2015, $15,000 in 2016. In 2017, they had an NOL of $12,000. If they elect to go ahead and carry it back, they will offset $10,000 of that income, and then the remaining $2,000 will be offset for 2016. 100% of it, because it happened 2015, 2016, 2017. Okay? So they're under that old rule. They carry it back 2 years and then carry it forward 20 years and they get to offset 100%. Same information. They elect to waive the carryback period, so they're not going to go back. Prior to any consideration of NOL, they earned $8,000 in 2018, $21,000 in 2019. They would apply the 2017 NOL to 2018 first. So it would offset that whole $8,000. How much do they have? $12,000. They've got $4,000 left. In 2019, they would report net income of $17,000, the pre-NOL net income of $21,000 minus the remaining $4,000 NOL carry forward. Okay, so that's fairly simple because they didn't really say it was $21,000 anyway. Oh yeah, there they did, right there. All right. Xavier Corporation, formed in 2017, earned $50,000 in 2017, earned $5,000 in 2018 and 2019. In 2020, they had an NOL of $75,000. They're not going to waive, they are not waiving the carryback period, so they're going to go back. The NOL would first be carried back to 2017, which results in zero income for that year. So 2017 earned $50,000 NOL. Okay, so they're going to take, so we're going to offset the $50,000 of the 75. We've got 25,000 left, and then we would apply, let's see, reduce the net income of 5,000, so now we've got 20,000 left, and another 5,000 in 2019, so we've got 15,000 left. All right. Now, same information, except they earned $16,000 in 2021. The NOL carry forward to 2021 is limited to 80% of the taxable income. So now it's a little bit more complicated because we've got that 80% limitation. And I know you've got a homework problem that involves this, by the way. I know you've got homework problem that has to do with, it's a mixed up different rules for different years, okay? All right, so they earned $16,000 in 2021. NOL carry forward in 2021, limited to 80% of 2021 taxable income. So it's limited to $12,800. So the taxable income after the carry forward is $3,200. So $16,000 minus $12,800. And then they'll have an NOL carry forward of the rest of that of $2,200. So they can't use all of it in 2021 because, where is it up here? Oops, I went too far. 2021 or later, not eligible for carryback. Offset up to 80% of taxable income in the carry forward year. Okay? So that's NOLs. Some differences there. Questions? Dividends received deduction, capital loss carrybacks and carry forwards, charitable contribution limitations, net operating loss deductions, carrybacks, carry forwards, and that depends on the year that it was generated, what that treatment is. Yeah.
For the carry forward for the losses, so I was looking at one of the homework problems, so if they have two separate losses, can you apply both of them, or is it still just like 80% of the income?
Whatever, it depends on the year. So if it's 100% year, then you can apply 100% of it.
If it's 2021, that'd be an 80%.
That's an 80% year.
But if like one of the losses was incurred in 2017 and the other one was incurred in would it still just be limited to 80% of the income for 2021?
Then I think it's, and you're carrying it forward
Yes.
to that year, then I think it's 100% because of the year that it was incurred.
So you could do 100%.
I think. Hold on a second. Yeah, because it's talking about when the NOL was generated. So if it was generated on or before December 31st, 2017, you can use 100% of it.
Okay.
If it was generated 2018, 2019, or 2020, you can use 100% of it. After 2020, if it was generated after 2020, you can only use 80%. It can only offset 80% of taxable income.
So it's based off of when it was in.
When it was generated.
Because I think in the example then it should be 0, but it's telling me that's wrong.
Okay, let me take a look at it.